Hi, and thanks for joining our call today. We're happy to have you here. My name is Jason Karras, and I'm a private wealth advisor at Westwood Wealth Management and a licensed attorney. Before joining Westwood, I served in both trust administration and private legal practice and estate planning for over 7 years. I'd also like to introduce you to my teammates, Carla Dominguez and Susan Wedlick. Carla and Susan are also attorneys, and they've been serving in trust administration for over 20 years. We thank you for joining us today for our topic, estate planning considerations during coronavirus. Over the past 5 months of dealing with the pandemic, we have kept in touch with our clients on a regular basis. And time again, we have been hearing the same questions and concerns from them. So we decided to address some of these issues on this forum, and we'll break the call up into 3 sections: income tax rates and possible changes, changes in the IRA rules, and gifting options given possible estate and gift tax changes. So Susan, I'll start with you. There's been an unprecedented amount of stimulus this year due to COVID. One can expect that the tax rates will rise in the future to pay for that stimulus. Since the income taxes are at a very low rate this year, what should our clients be doing right now to take advantage of the current low income tax brackets?
That's a great question, Jason. And yes, due to the stimulus, it is likely that income taxes are going to rise for everyone. One really easy way is to maximize contributions to tax-deferred accounts for future expenses like medical, education, and retirement. This way, our clients can take advantage of the tax-free growth in those accounts. Also, one should consider the income tax savings of making charitable donations directly from your IRA. The maximum amount an individual can make from their IRA to a charitable organization is $100,000. It's important to consult with your accountant and determine whether you get the larger tax benefit from taking the itemized charitable deduction or reducing your taxable income by making the charitable donation directly from your IRA. If you're still employed, there are a couple of tax-deferred accounts that you can utilize: health savings accounts, 401k, traditional IRAs, and Roth IRAs and 401ks. Medical expenses are also on the rise, and many employers are now offering a health savings account. It's unique because you don't have to use the money every year, and you can invest the proceeds and let it grow tax deferred. An employee would contribute money pre-tax, and the assets grow tax deferred. Personally, I don't have high medical expenses right now. For this reason, I've been maxing out my contributions to my health savings account because I want to use the money later. The goal is to invest these dollars, allow them to grow tax deferred, and use these funds during retirement for qualified medical expenses and withdraw the money tax-free. If you're eligible, consider contributing to a Roth IRA. There's a huge difference in a retiree's tax bill if he has a portfolio 100% invested in IRAs and 401ks versus an individual who has his retirement assets apportioned across different types of accounts that are pre-tax, after-tax, and Roth accounts. The latter, the Roth account, will have a much lower tax bill in retirement, and his or her heirs will inherit assets in a much more friendly tax status. This is because Roth IRAs are very unique. They have no required minimum distribution rules. And when you take assets out, the beneficiary or the heirs or the retiree, they don't have to pay taxes on that. And some, a Roth IRA is funded with after-tax dollars. Assets grow tax deferred. And when you take it out during retirement or your heirs withdraw it later, the withdrawals are tax-free. If you meet the income limits, consider maxing out your Roth IRA contributions. And in addition, you should check with your employer to see if they're offering Roth 401ks. This gives clients a higher contribution limit and allows higher income earners to take advantage of the Roth.
That's good information, Susan. Thank you. I've also been hearing more about Roth IRA conversions lately. Can you tell me the advantages of that in light of the changes made recently by the Secure Act in response to the pandemic?
Sure. This year's really unique because the Secure Act waived the requirement for required minimum distributions this year. And this is resulting in many retirees having a lower than expected income tax bracket in 2020. A person in this situation or a couple might consider converting some of the IRA to a Roth IRA while they're in these lower income tax brackets. By doing so, you can withdraw assets and your heirs can inherit assets with a much more friendly tax status. It's important to talk to your accountant to determine your projected 2020 income tax bracket. And if it's lower, you can work with your accountant and your Westwood advisor to determine if it makes sense to convert some of your traditional IRA to a Roth IRA. And there's no income limit for doing this.
Thanks, Susan. As we know, the IRA rules changed last year to eliminate the ability for an adult child to inherit an IRA and stretch the benefits over their lifetime. And it is important to note that a spouse or a disabled adult child can still inherit an IRA and stretch the benefits over their lifetime, but now everyone else must take it in 10 years from the account holder's death, which obviously could bring hefty tax bills. What should clients be thinking about in this regard?
That's a great point, Jason. You know, we used to be able to stretch the IRA benefits over an adult child's lifetime, and now that's no longer there. If you're charitably inclined and you're planning to leave money to a charity anyway, you might want to consider making that charity the beneficiary of some or all of your IRA upon your death. Your estate gets the benefit of the charitable deduction on your death, and it saves your beneficiaries income tax by leaving them other assets that are after tax. If you still want to provide your child with an income stream for life from the IRA, but you also want to benefit a charity, consider a charitable remainder trust as a tool to extend the life of that IRA. A charitable remainder trust creates an income stream for the beneficiary during their life, and the remainder will go to charity. The assets will grow on a tax-deferred basis in the trust, while the beneficiary will pay taxes on the income he or she receives. Charitable remainder trusts are not an easy fix, though. It's important to work with your estate planning attorney, accountant, and Westwood advisor. The attorney will draft the trust document, and we can crunch the numbers on the appropriate amount of income that we need to pay out to your beneficiary. There's specific rules, and you must pay out 5% of the fair market value to the beneficiary each year, and the remainder left to the charity must be 10%.
It's a good point, Susan. Regardless of how you proceed, now it's definitely a good time to revisit the beneficiaries of all your accounts, and especially your retirement ones. So Carla, I've been hearing rumors that the estate tax exemption levels could change. What does that entail, and what exactly are these rumored changes?
Thank you, Jason. Admittedly, we currently have in place what is probably the most favorable federal estate and gift tax regime of recent times. Today, a person can leave $11,580,000 free of estate or gift tax, and a married couple can leave double that, or $23,160,000. These tax exemptions are linked. So if you use your gift tax exemption during your lifetime, this decreases the amount of federal estate tax exemption that will be available when you pass away. In 2020, we have seen the world turned upside down for several reasons, but mainly because of COVID, which is wreaking havoc in the United States, and in its wake has brought on the need for a stimulus package, possibly two, to be decided soon here by our Congress. Add to that our upcoming election in November, which could potentially bring in a new administration that has a different view on taxes and tax rates. If that is the case, there is no guarantee that the very favorable tax rates in place today will remain the same. Federal income taxes, estate and gift taxes could come under review shortly thereafter as a prime area to help offset some of the expenditures made recently. Even if there is no change in the administration, unless there is a change in the law, these exemption rates will sunset or decrease in 2026 and return to pre-2017 levels of 5,490,000, adjusted for inflation, so a bit more.
So Carla, given what you described, what are some of the things that our clients should be considering?
Well, and I hate to give the lawyer answer here, but it completely depends. It depends on the client and what their goals are. If they are so inclined, this is a good opportunity to take advantage of these high gift tax exemptions by making gifts to their loved ones. We know that there may be changes coming, so if this is something that they've been thinking about, it might be time to start exploring the option more in depth. So a few things to think about. First, and most importantly, do you have enough money for yourself and your spouse, for your current needs and for your future needs? As people age, their expenses tend to increase primarily due to medical care. So you want to make sure that you have enough. If you find that you do have enough funds and you want to make substantial gifts, where do you want those gifts to go? Do you want them to go to your children, your grandchildren, charities, a combination of all of the above? And do those gifts go outright to them or in trust?
Well, those are important questions. If our clients do decide to make those gifts, what are some of the important considerations to keep in mind with the gifting?
Of course, again, it depends. Here, it depends on what the assets are that make up their wealth. Do they hold mostly liquid assets like cash or a securities bond portfolio? Do they own their own business? Is their wealth tied up in an existing entity already? And as we discuss which assets to gift, another important consideration is the basis of the assets. Basis means how much they originally paid for the asset. Generally, it's better to keep the assets that have already appreciated since the initial purchase. Why? At death, a person's assets get a step up in cost basis. And so what does that mean? It means that the basis, what you originally paid for the asset, gets revalued to current market value at your death. For example, say you paid $10 for Starbucks stock in 2008. That same stock today is worth about $75. You're sitting on $65 of unrealized gains. If you die today holding that stock, it gets revalued to $75. So if your executor sells it, the net effect is zero. The same holds true if there's a decrease in price, or a step down, if you will. The net effect is zero, and unrealized gains or losses are effectively wiped out. However, if you were to gift that same stock, the recipient receives the same basis you paid for it. In my example, it would be $10, and the recipient would pay the capital gains on the $65 appreciation if he sold it. That can play a significant factor in the decision of what assets to gift, among other things.
Well, that brings us to the heart of the matter, really. There seems to be many different factors to consider. So how should our clients structure these gifts to take advantage of the favorable exemptions?
Sure, you're right. There's different ways to make gifts, but of course, the best bang for your buck is to take advantage of discounts for an already lower valued gift. For instance, if you're a business owner that has been thinking of making gifts, you now have a unique window of opportunity. As a result of the ongoing pandemic, the valuations of small to mid-sized closely held businesses have been significantly affected. Current valuations are down from where they were towards the beginning of 2020. With business values reduced, you can have a more favorable tax climate to make a gift. The one thing to keep in mind is that a gift of an interest in a closely held entity needs to have a credible business appraisal. Another option available is gifting through intra-family loans. We keep hearing about how we're living through these historically low interest rates. We have low mortgage rates, low car loan rates, and that also holds true for loans between family members. Low interest rates means that there's an opportunity to gift via loans to your children or grandchildren. You lend the money to your children, outright or in trust, and your children use the loan proceeds for investment opportunities. When setting up the loan, you typically apply the applicable federal rate of interest. In July's rate, it was 0.17% if the loan term was 3 years or less, and the same will be true for the August rate. In time, you can choose to forgive the loan or you can extend it. And for those of you on the call that may have an existing intra-family loan at higher interest rates than the one I just described, you may want to explore a refinance option for it.
And those are great strategies, Carla. Thank you. Are there any other options our clients should be thinking about?
One item that we haven't talked about yet is the generation skipping transfer tax, or GST. The GST tax comes into play when grandparents make gifts to grandchildren or future generations down. This tax has the same exemption rates as the federal estate and gift taxes that we've been talking about, which again is currently about $11,580,000 per person. Barring any changes, it will sunset in 2026 and go back to that $5,490,000 figure, again adjusted for inflation. If a client intends to make gifts to their grandchildren or later generations, depending on the value of that gift, we strongly encourage a trust structure for them. As the laws stand today, they can create a trust, allocate all or part of their GST exemption to it, and avoid the GST tax on the transferred amount and all appreciation after the date of the gift. So if their initial gift is left untouched, it can grow GST tax-free for their grandchildren's lifetimes.
Thanks, Carla. So what if a client doesn't feel comfortable, though, making large or complicated gifts right now? Are there less complicated or smaller gifting options available that might meet some clients' needs?
Of course. The simple answer is don't gift, don't make any gifts. You are still able to give every year up to $15,000 per individual, double that amount for a married couple as a gift, and that does not need to be reported to the IRS. You may also use your unlimited exclusion to pay tuition and medical expenses directly to the provider for another person. And finally, in these uncertain times, there's always the option of holding off on gifting of any sort until things begin to stabilize and you are more comfortable with your individual situation.
Well, Carla and Susan, thank you very much for that great information. Given the current pandemic, we do strongly encourage everyone to review their estate planning documents, whether it's their wills, their trusts, their medical powers of attorney, their general powers of attorney, and their healthcare directives to ensure their wishes are being met. It's also wise to consider whether any of these strategies that we discussed today might benefit our clients' estates or their loved ones. So for further information, please see your Westwood Private Wealth Advisor. Thank you for joining us today, and goodbye.